Welcome back to Finance Desk. If you have looked at your portfolio, right, and you hold Indian IT stocks in them, then definitely you have had a rough ride this year. The Nifty IT Index fell more than 30% from January 2026 to June 2026. And something unexpected happened. In July month alone, it rallied for about 20%. So today I want to answer the questions a lot of people have. Has it finally bottomed out and is it time to start buying Indian IT stocks? I have a slightly different perspective here because I myself work in the IT industry and that gives me a closer view on what exactly is happening inside these companies. But also it means I have a bias, so I want to be honest about it. So let's start with the numbers because this story has two different chapters. So the first one is Nifty IT Index fell over 30% in the first half of 2026 and that makes it the worst performing major sector on the exchange. And chapter 2 in July alone the index rallied around 20%, its best month since July 2020 and stocks like HCL Tech, LTI Mindtree, Persistent System have rallied anywhere between 25 to 30%. And on valuation front, right, the index trades at about 18.3 PE, which is well below its 5-year median of 27. For years, right, Nifty stocks traded at a premium of 17% compared to that of Nifty 50. Now that premium is gone. The index fell hard and bounced back and now it looks cheaper to compare to its own history. This is exactly the setup that excites most of the people to buy the dip. So why did this crash happen in the first place? The short answer is the fear of artificial intelligence. Since early 2026, right, the agentic AI tools that can write, test and debug code has gone mainstream and big clients have started asking a blunt question. If AI can do all of these things, right, why am I paying a large team of people? So that pressure showed up in the growth numbers. So analysts have cut their growth expectation for this sector to 3 to 6 percentage from earlier historical average of 7 to 8 percentage. This is not a small thing to ignore because this is how the market is pricing in the growth that can be expected in the sector. And this is the part I understand the best because I have seen this happen in my own workplace. For about 30 years, right, Indian IT companies have been running under the simple formula more people means more billable hours, more billable hours means more revenue. Think of it like Ola and Uber. Add more cars and add more drivers, then as long as all of these are booked, right, your revenue goes up. This is exactly how these IT companies grew. A client wants a project to be done, the IT services company assigns a set of people, and revenue was basically headcount into billing rate. More headcount was always treated as a positive signal because it meant higher billable capacity. AI now is breaking that formula because a small team with the AI tools can do the same job that used to take 3 to 4 times the people. In other words, if 30 to 40 people were required for a project, today, right, it can be executed with just 10 people with AI tools. Let us go ahead and put real numbers here because this is not a theory and we are seeing this already happening in the data. In FY26 alone, right, the top IT companies that is TCS, Infosys, HCL Tech, Wipro and Tech Mahindra combined have cut around 7,000 headcounts. And when you compare it with FY25, right, same companies have added around 12,700 employees. And the scary part, right? TCS alone have cut around 23,000 employees after announcing that it will cut 12,000 employees in FY26. On an average, right, TCS alone used to hire around 40,000 freshers every year. And for FY27, right, TCS has guided it will hire only 25,000 freshers. So you can see that old formula meaning more headcount means more revenue, right? That is actually breaking down. Since I work in the IT industry, right, I'm not just looking at the charts or the reports. I'm seeing hiring slowdown around me and I'm also seeing the teams getting cut down because same work that used to take larger teams, right, can be done with a smaller team with AI. That gives me real context because I'm seeing it from the inside. It also adds a risk that I can be overconfident. You can start thinking that your personal experience is the full picture and my experience is only one data point from one company. So we can take it as a supporting clue, not as a main evidence. Now look at the other side because bull case is also strong. Foreign institutional investors, right? They have cut their stakes in 7 out of 10 Indian IT companies in the June quarter. And soon after that in July month, right, we have seen the index bounce about 20%. And this is a common pattern in the market. Whenever the FIIs are very pessimist, right, we see a turnaround in that sector or in that market. Jeffries, right, had an underweight rating on the Indian IT sector for a long time. Now they have changed their rating to neutral and they have added Infosys to their model portfolio. And the weaker rupee also helps here because they earn in dollars and report their revenue in rupees. And in first quarter of FY27, right, the earnings have started to pick up and there were not major negative news. So this is not just blind optimism. So here is the question I keep coming back. Cheap compared to what exactly? A PE ratio of 18 looks cheaper compared to historical average of 27, but the problem is this 27 was against the growth expectation of 7 to 8 percentage. Now the growth expectation is just 3 to 6 percentage. So when the growth expectation is a lower rate, the valuation will also should be lower. So being cheaper compared to its own history doesn't mean being cheap. It might simply mean that the market is pricing in the slower growth. So that was a sectorial view. This part is especially for people who are working in the IT sector. If you're working in this industry, right, you have to think before you're buying more IT stocks. Your salary depends on this sector, your annual bonus depends on it, and for most of us, even ESOPs depend on it. Now you're also putting a large chunk of money in the IT sector companies. So that means you're taking the same bet 3 times over. Your job, your bonus, and your portfolio connected to the single industry. This problem is not unique to IT because a banker who buys banking stocks will also have the same problem. To be clear, I'm not saying completely avoid IT stocks because you work in IT. All I'm saying is you should size your position more carefully than compared to an outsider. Imagine a friend who is a banker calls you and asks you, should I invest in this banking stock? What you would say? You will tell that you already work in banking sector, why you want to put more money and take more risk in the same sector. So same logic applies here as well. So if you're working on IT sector, right, reduce your position sizing in this sector. You can consider other sectors for investing. So practically what should you actually do? First, do not stop your research at it looks cheap, so let us go ahead and buy it. Check whether the analysts are cutting the earnings estimates for the next 2 to 3 years. Also check if the estimates have started to stabilize. A fall in price to earnings does not mean it is at a bargain. If the earnings estimates is also falling, right, then the stock might be just catching up with the bad news. Second, watch headcount and revenue per employee for few quarters. Do not judge everything based on 1 month rally that happened in July. And if a company can grow its revenue when the headcount stays flat or let us say it falls, right, then that is a good sign. It means that company has started adapting successfully. Third, if you decide to invest, right, then stagger your investments into multiple months. Do not invest everything in one go. Nobody knows when this AI related uncertainty, right, that will be priced in. And even I don't know either. The impact is expected to continue from FY26 to FY28. And fourth, keep your overall allocation capped in this sector. And if you work in IT, right, even further reduce your allocation. So is it time to start buying IT stocks? My honest answer is maybe, not a clear yes. The sector looks cheap on paper, the bull case has a real advantage, but the revenue which is linked to headcount that seems to be under pressure and 1 month of rally is not going to fix all these problems. And personally, I'm adding very small positions and I'm spreading my investments over multiple months. And this is definitely not a recommendation. This is just my view. Please do your own research and if you have any doubts, please consult a fee only financial planner. I hope that gave you clarity. It is not an extreme case that the IT is finished or it is not like you should go YOLO with the IT stocks and invest everything in it. It is somewhere in between. If you found this video useful, please consider subscribing and I have other videos in the channel as well. Go check them out and I will see you in another video.